$20,000 turned into $5 million in weeks. Silver shot up 272% in 1 year, hit $121 per ounce on January 29, 2026, then crashed 38% in a single day. RJO Futures Daniel Pavlonis just called it a 7 sigma event, something that should mathematically happen once every 3.4 billion trading days. It happened last week. And if you're holding silver right now, what comes next will determine whether you made the trade of your life or walked into the single most brutal trap in commodities history. Welcome to Capital Anchor. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you're new here, subscribe right now, because what I am about to show you about silver's parabolic rally and violent crash could change how you see precious metals forever. This is not a story about price charts. This is a story about leverage, margin calls, and what happens when retail investors go all in on a trade that institutions were already preparing to exit. Let's start with exactly what happened. On January 1, 2026, silver opened near $70 per ounce. By January 29, 2026, it had surged to an all-time nominal high of $121 per ounce. That's a 73% gain in 29 days. For context, silver had spent 45 years from 1980 to 2025 trying to break above 50 per ounce. It finally did in October 2025, hitting $53.76. Then it exploded. November, $57.24, December, $82.67, January, $121. The velocity was unprecedented, but velocity cuts both ways. On January 30, 2026, between the morning of January 29 and the afternoon of January 30, a span of less than 30 hours, silver plunged from 121 to an intraday low just below 75 per ounce. That is a 38% crash. The March 2026 COMEX silver futures contract dropped 31.4% in a single trading session on January 30, marking silver's worst day since March 1980. As of February 10, 2026, silver is trading around $83 per ounce. It has recovered, but it is still down 31% from the January 29 peak. This is where the 7 sigma event classification comes in. A 7 sigma event, in statistical terms, is a move that is 7 standard deviations away from the mean. In a normal distribution, this should occur once every 3.4 billion days, or roughly once every 13 million years. Yet it just happened in silver. That tells you one thing: the market was not behaving normally. It was behaving like a pressurized system about to explode. So what caused the explosion? The answer is not what most people think. The mainstream narrative is simple. Silver rallied because of supply deficits, industrial demand from AI and solar, and safe haven buying. Then it crashed because President Donald Trump nominated Kevin Warsh to chair the Federal Reserve on January 30. And Warsh is a monetary hawk who opposes easy money, so investors dumped precious metals. That narrative is half true, but it misses the hidden mechanism that actually drove both the rally and the crash. Here is the mechanism most retail investors ignore: leverage. Silver is a thinly traded market compared to gold. A single COMEX silver futures contract controls 5,000 troy ounces of silver. At $28 per ounce, that contract is worth $140,000, but the margin requirement, the upfront cash you need to control that contract, is only a fraction of that amount. This leverage allows traders to control massive positions with small amounts of capital. Now imagine what happens when the price starts moving in your favor. Your $20,000 account can control $500,000 worth of silver. If silver moves up 20%, you don't make 20%, you make 500% or more, depending on your leverage. This is how YOLO traders turn $20,000 into $5 million, according to Daniel Pavlonis of RJO Futures. They bought deep out of the money call options on silver futures when silver was trading in the 60 seconds and 70 seconds in late December 2025 and early January 2026. When silver exploded to 121, those options went from worthless to worth hundreds of thousands of dollars each. But here is the flip side. Leverage magnifies losses just as much as it magnifies gains. When silver started dropping on January 30th, the same traders who made 25,000% returns in weeks got margin calls. A margin call means your broker is telling you, you don't have enough money in your account to cover your losses. You have two choices. Deposit more cash immediately, or we close your positions for you. And when the broker closes your positions, they sell at market price, whatever the market will pay right now. When thousands of traders get margin calls at the same time, they all try to sell at once. This creates a feedback loop. Selling drives the price down. Lower prices trigger more margin calls. More margin calls force more selling. The market becomes a runaway train with no brakes. This is not theory. This is exactly what happened on January 30, 2026. The Chicago Mercantile Exchange CME, which runs the COMEX where silver futures trade, raised margin requirements on silver during the crash to stabilize the market. When they raise margin requirements, it means traders need to put up more cash too. Hold their positions. If you can't meet the new requirement, you get liquidated. Matt Maley, equity strategist at Miller Tabak, said on January 30th, "This is getting crazy. Most of this is probably forced selling. This has been the hottest asset for day traders and other short-term traders recently. So there has been some leverage built up in silver. With the huge decline today, the margin calls went out." Think of it this way. Imagine a crowded theater. Everyone is sitting, watching the show. The show is great. The theater is packed. Then someone yells fire. Even if there is no fire, what happens? Everyone rushes for the exit at the same time. The exit is narrow. People push. People fall. Panic spreads. The damage is not caused by fire, it is caused by the stampede. That is what happened in silver. The fire was the Warsh nomination, but the stampede was caused by leverage. Now let's talk about why the rally happened in the first place, because this is where you see the big player versus retail disconnect. There were 3 real reasons silver rallied to $121. Reason number 1, structural. Supply deficits. According to the Silver Institute, the silver market has been in a structural deficit for 5 consecutive years as of November 2025. Demand exceeds supply. In 2024, industrial consumption surged 7% to over 700 million ounces, a record. The renewable energy sector, especially solar panels, is consuming silver at an accelerating rate. Solar panels alone are expected to consume 100% of global silver supply by 2050 if current trends continue. At the same time, global silver mine supply has been declining. Mexico's regulatory changes in 2024 and 2025 cut expected output by 5% in affected regions. Russia faces sanctions and capital constraints. Several major primary silver mines are near end of life with no large new projects ready to replace them. COMEX and LBMA inventories both drew down through 2024 and 2025. Available good delivery bars tightened significantly by the end of 2025. This is real. This is not hype. Silver is being consumed faster than it is being produced, and stockpiles are shrinking. Reason number 2, the debasement trade. Throughout 2025, investors became convinced that the U.S. Federal Reserve would be forced to keep interest rates low to accommodate soaring federal debt and political pressure for economic growth. This belief drove massive inflows into precious metals. Investors were betting that the U.S. dollar would weaken, inflation would stay elevated, and the Fed would print money to cover deficits. In the first half of 2025, silver exchange-traded products saw a record inflow of 95 million ounces. Retail investors who had been sitting on the sidelines since 2020 piled in. When silver broke $30 per ounce, they bought more. When it broke $50, they bought even more. When it hit $70, they went all in. This is classic momentum trading. The price goes up, so people buy because the price is going up, which pushes the price up more, which attracts more buyers. It becomes a self-reinforcing loop. Until it doesn't. Reason number 3, China and geopolitical uncertainty. China implemented export restrictions on certain metals in 2025, which fueled fears of supply disruptions. The U.S. was involved in escalating tensions with Iran, threats over Greenland, and the capture of Venezuelan President Maduro in January 2026. Geopolitical chaos typically drives safe haven buying in gold and silver. In Japan, Prime Minister Sanae Takaichi's ruling coalition won a landslide election in early February 2026, paving the way for expansionary fiscal policy and a weaker yen, which also supported precious metals demand in Asia. All of this created a perfect storm of bullish narratives for silver. Now here is the disconnect. While retail investors were buying silver in January 2026 because they believed the debasement trade would continue forever, the big players, the institutions, the hedge funds, the commercial traders were watching a different set of signals. They were watching the US dollar, they were watching real interest rates, they were watching political developments around the Federal Reserve. And most importantly, they were watching positioning. By late January 2026, silver was massively overbought. Speculative net long positions in COMEX silver futures were at multi-year highs. Retail sentiment was euphoric. Analysts from Citigroup were calling for $150 per ounce within 3 months. Bank of America ranked silver as the asset with the highest bubble-like dynamics in their January 2026 report. When an asset is trading 30% above its key moving averages, when sentiment is universally bullish, when everyone from your barber to your Uber driver is talking about silver, that is not the beginning of a rally, that is the end, and the big players knew it. U.S. Treasury Secretary Scott Bessent said on February 9, 2026, that the extreme swings in precious metals were driven by Chinese traders and described the January 29 top as a speculative blow-off. In other words, the rally was driven by speculation, not fundamentals. When speculation drives a market, the rally ends the moment the narrative changes, and on January 30, 2026, the narrative changed in one sentence. President Donald Trump announced, "I am nominating Kevin Warsh to be the next chair of the Federal Reserve." Kevin Warsh is a former Federal Reserve governor who served from 2006 to 2011. He is known as a monetary hawk, someone who opposes inflation and supports higher interest rates to control it. During his time at the Fed, Warsh publicly criticized the second round of quantitative easing in 2011, calling it dangerous for long-term inflation. He resigned shortly after. In 2025, Warsh published an op-ed in the Wall Street Journal titled "The Federal Reserve's Broken Leadership," where he argued that inflation is a choice made by central banks and called for aggressively shrinking the Fed's $6.6 trillion balance sheet. The market interpreted Warsh's nomination as the end of the debasement trade. If Warsh becomes Fed chair, interest rates will stay higher for longer. A stronger dollar, lower inflation expectations, and precious metals which do not pay interest and only go up when investors fear currency debasement lose their appeal. Within hours of the announcement, gold dropped 16% intraday before recovering to around $4,900 per ounce. Silver dropped 39% intraday before bouncing back above 85. The dollar index surged 0.8% on January 30, 2026, and the selling did not stop there. By February 6, 2026, silver had fallen to an intraday low of $75 per ounce. So while retail investors were celebrating triple-digit silver and posting screenshots of their gains on social media, institutions were quietly positioning for the exit, and when the Warsh news hit, they got out first. Retail got crushed. Because the crash did not fix the underlying problem. And that is what almost nobody is talking about today, February 10, 2026. Let me take you back to 1980. Silver hit $49.45 per ounce on January 18, 1980. 2 months later, on March 27, 1980, a day remembered as Silver Thursday, silver crashed to $10.8 per ounce. A 78% collapse in 69 days. That crash was blamed entirely on the Hunt brothers. 2 Texas billionaires named Nelson Bunker Hunt and William Herbert Hunt. The mainstream story goes like this. The Hunts cornered the silver market, controlled 1/3 of the world's deliverable supply. Drove prices from $6 to $50, got hit with margin calls when COMEX changed the rules with Silver Rule 7 and the whole thing imploded. End of story, except that narrative is incomplete. Yes, the Hunts accumulated over 195 million ounces of silver through physical holdings and futures contracts. Yes, they leveraged heavily. Yes, they got margin calls and lost over $1 billion. But here is what most people miss. Gold also peaked on the exact same day as silver, January 21, 1980. Gold hit $850 per ounce. Platinum, palladium, and oil all surged in the same time frame. The Hunt brothers were not buying platinum, palladium, or oil. So what really drove the 1980 rally? The truth is this: the United States was facing a currency crisis. Inflation was over 13%. The dollar was collapsing. People around the world were fleeing paper money and scrambling into hard assets. The Hunts accelerated the silver rally, yes, but they did not create it. The real force was fear of dollar collapse, and when that fear subsided when Paul Volcker raised interest rates to 20%, crushed inflation, and stabilized the dollar, the entire commodity complex crashed. Silver fell the hardest because it is the most leveraged and thinly traded, but the Hunt brothers became the scapegoat. It was easier to blame two billionaires than to admit the system almost lost control. Now fast forward 46 years to January 2026, silver hit $121 per ounce. Then it crashed 38% in 30 hours. The mainstream narrative this time: YOLO traders speculated on call options, got over-leveraged, panicked when Kevin Warsh was nominated Fed chair, and the whole thing blew up. Margin calls everywhere. Forced liquidation. Same story, different decade. But here is what has not changed. The supply deficit is real. COMEX registered silver inventory, the silver immediately available for delivery against futures contracts, has dropped 75% since 2020. As of early February 2026, registered inventory sits around 103 to 113 million ounces. Total COMEX inventory, including eligible metal that is not yet available for delivery, is around 403 to 411 million ounces. But here is the critical part. Only 30% of reported COMEX silver can actually be delivered right now, and people are demanding delivery. In the first week of January 2026 alone, 33.45 million ounces of silver were withdrawn from COMEX for physical delivery. That is 26% of the entire registered inventory. Gone in 7 days. For the full month of January 2026, deliveries reached between 40 to 49 million ounces. That is 7 to 10 times higher than the historical January average. This is not normal profit-taking. This is front-running. Institutional players are pulling physical silver out of the system before March 2026, which is COMEX's primary delivery month. Why March? Because March typically sees the highest delivery volume of the year. In December 2025, COMEX processed 46.635 million ounces in deliveries, 50% of the estimated free-float registered inventory. For March 2026, open interest in the March silver futures contract currently represents approximately 500 to 528 million ounces notional. That is over 100,000 contracts at 5,000 ounces per contract, if even 20% of those contracts stand for delivery, which is conservative based on recent trends. March faces delivery requests of 100 to 106 million ounces. There is not enough registered inventory to cover that, not even close. So what happens when COMEX runs out of deliverable silver? 3 scenarios. Scenario 1, COMEX forces cash settlement instead of physical delivery. Probability, 60%. This is the most likely outcome. If COMEX cannot deliver physical silver, they will offer traders cash at the contract price instead of actual metal. This protects the exchange but destroys confidence in paper silver markets. Once traders realize they cannot get physical metal when they want it, the premium for physical silver over paper silver explodes. You will see 2-tier pricing: one price for paper futures, one price for physical bars and coins. The physical price will be higher. This already started happening in early 2026. London lease rates. The cost of borrowing physical silver spiked to 34.9% on October 9, 2025, with intraday peaks hitting 39.2%. By late October, rates fell to 5.6%, but that is still 5 times higher than normal sub-1 levels. When it costs 5% to 35% per year to borrow silver, that tells you one thing: there is not enough physical silver to go around. Scenario 2, COMEX changes the rules again, just like 1980. Probability, 30%. In 1980, COMEX introduced Silver Rule 7, which banned new silver purchases on margin. The Hunt brothers could no longer leverage. The market collapsed. In 2026, COMEX could raise margin requirements dramatically, limit position sizes, or restrict delivery altogether. This would break the rally, force liquidations, and protect the exchange. But it would also confirm that the paper silver market cannot function without intervention. That is a loss of credibility. And once credibility is gone, it does not come back. Scenario 3. A massive silver short squeeze pushes prices to 150 to 200 per ounce before the system breaks. Probability, 10%. This is the tail risk. If delivery demand accelerates faster than COMEX can manage, and if institutional players refuse cash settlement and demand physical delivery, you get a short squeeze. Short sellers, traders betting silver will fall will be forced to buy silver at any price to cover their positions. There is not enough physical silver available to cover all the short positions. Prices spike violently. This happened briefly in January 2026 when silver hit 121. But it got shut down by the Warsh news and margin call liquidations. If it happens again, and if traders hold their positions instead of folding, silver could hit $150 or higher before the system either delivers or defaults. Now, on the record, my prediction for silver by the end of March 2026, $95 per ounce. Screenshot this. Silver is trading at $83 today, February 10, 2026. I expect a rally back toward 95 within the next 6 weeks as March delivery demand intensifies and physical tightness becomes undeniable. The crash from $121 to $75 flushed out the most over-leveraged speculators. That was necessary. But the structural drivers, the supply deficit, industrial demand, geopolitical uncertainty, and COMEX inventory drain are still intact. Those do not go away because of a margin call sell-off, so silver will recover. But it will be volatile. Do not expect a straight line. Beyond March, I expect silver to trade in a $75 to $110 range for the rest of 2026, with a year-end price around $100 to $105 per ounce. The key variable is whether COMEX faces a delivery failure in March. If they do, all bets are off. You could see $150. If they manage the situation with cash settlements and rule changes, silver consolidates in the $80 to $100 range and builds a base for another rally in 2027. So what should you actually do right now? Here is practical advice based on your situation. If you are holding physical silver bars, coins, anything in your possession outside the banking system, do nothing. Hold. The January crash was terrifying, but it changed nothing about the fundamentals. You are holding an asset that is being consumed faster than it is being produced, that industrial sectors cannot substitute, and that central banks and institutional players are quietly accumulating. Physical silver premiums over spot prices are still elevated. That tells you demand for real metal remains strong. Do not sell into weakness. If you need liquidity, sell a small portion. But your core position should stay intact. This is a long-term hold. If you bought silver at $100 or higher and you are underwater right now, you have two choices. First choice, hold through the volatility and wait for the March delivery squeeze to push prices back up. You are down 15% to 30% from your entry. That hurts. But if my $95 target is correct, you will recover most of that loss within 6 weeks. The fundamentals support a recovery. The question is whether you can handle the psychological stress of holding a losing position. If you can, hold. If you cannot, cut your position in half, take the loss, and protect your mental capital. Trading is psychological warfare. You cannot win if you are paralyzed by fear. If you are trading silver with leverage futures, options, or margin, cut your position size immediately. The January crash showed you exactly what happens when volatility spikes and margin requirements change overnight. If you are using 5x or 10x leverage, one bad day can wipe you out completely. Reduce your leverage to 2x or 3x maximum. Use stop losses. Do not hold leveraged positions through major delivery months like March unless you are willing to lose the entire position. The upside is huge, yes, but the downside is total. Respect that. If you are sitting on cash and waiting for an entry, this is your window. Silver at $83 after a 38% crash from $121 is a buying opportunity, but do not go all in. Scale in over the next 4 weeks by 25% of your intended position now, by another 25% if silver drops below 80, by another 25% if it drops below 75. Keep the final 25% in reserve for a true capitulation event if it happens. Dollar cost averaging protects you from mistiming the bottom. Now, here are the specific indicators you need to watch going forward. First, COMEX registered inventory levels. This data is published daily by the CME Group. Watch for continued drawdowns in registered silver. If registered inventory drops below 100 million ounces before March delivery, that is a red flag. It means the system is under extreme stress. You can track this data at websites like ShiftGold. or heavy metal stats. Second, the US dollar index DXY, silver and the dollar are inversely correlated. When the dollar weakens, silver rallies. When the dollar strengthens, silver falls. The DXY surged 0.8% on January 30, 2026, the day of the crash. If the DXY continues climbing above 110, that is bearish for silver. If the DXY rolls over and starts falling, that is bullish. Third, March COMEX delivery data. Watch how many contracts stand for delivery in March 2026. This data will be published in the final days of February. If deliveries exceed 80 million ounces, COMEX is in trouble. If deliveries stay below 50 million ounces, the exchange survives without drama. Fourth, gold-silver ratio. This is the price of gold divided by the price of silver. As of February 10, 2026, gold is around $4,900 per ounce and silver is around $83 per ounce. That gives a gold-silver ratio of about 59. Historically, the ratio averages between 60 and 80. When the ratio drops below 50, it means silver is outperforming gold, which is bullish. When the ratio rises above 80, it means silver is underperforming, which is bearish. Watch for the ratio to compress back toward 50 as silver recovers. Now let me tell you about the three types of people watching this right now. The first type is panicking. They bought silver near the top, watched it crash, and now they are frozen in fear. They are reading headlines about 7 Sigma events and YOLO trader wipeouts and convincing themselves they made a terrible mistake. They are going to sell at the worst possible time right before the recovery because they cannot handle the emotional pain of holding a losing position. The second type is doing nothing. They do not hold silver. They are not paying attention. They heard about the crash, shrugged, and moved on. They will wake up in 6 months when silver is at 120 and ask, how did I miss this? The answer is simple. They were not watching. They were distracted. The third type is learning. They understand that volatility is not risk, it is opportunity. They know that the January crash was a liquidation event, not a fundamental breakdown. They are tracking COMEX inventory. They are watching the dollar. They are positioning quietly while everyone else is either panicking or ignoring the situation. These are the people who will make generational wealth in the next 12 to 24 months. Which type are you? Here is what you need to understand about markets. Wealth does not transfer randomly. It transfers from the impatient to the patient, from the uninformed to the informed, from the emotional to the rational. The January 2026 silver crash was a forced transfer over leveraged traders who bought at $110 and $120. With 10x margin got wiped out, that money did not disappear. It transferred to the people who sold at 121 and bought back at 75. The system is designed this way. Volatility shakes out weak hands. And when the weak hands are gone, the asset recovers and moves higher. So ask yourself, are you trading based on headlines and emotion, or are you trading based on data and structure? Because the data says silver is in a structural deficit. The data says COMEX is draining. The data says industrial demand is accelerating. The data says central banks are accumulating. The headlines say YOLO traders lost everything in 7 Sigma crash. The headlines are designed to scare you. The data is designed to inform you. Choose wisely. Remember what I told you at the start of this video. $20,000 turned into $5 million, then back to zero for most of those traders. Because they used leverage they did not understand in a market they could not control. But the ones who made it out, the ones who sold near the top or held physical silver through the chaos, those people just lived through a once-in-a-generation event and survived. That is the difference between speculation and preparation. Silver is not done. The story is not over. March is coming, and what happens in March will determine whether 2026 is remembered as the year silver broke free from paper markets or the year the system forced everyone back into line. If this video gave you clarity while everyone else is confused, do me one favor. Hit the like button right now, subscribe to Capital Anchor if you have not already, and share this video with one person, someone who is holding silver and freaking out right now. They need to see this. Then drop a comment below and tell me, are you holding through March or are you taking profits now? I want to know where your head is at. This is Capital Anchor. I will see you in the next one.